anything that I talk to you about can be applied to really anything that you're looking to trade, and we'll talk more about that as we go on here. Right? So with that said, this is a picture of myself and my daughter, just to kind of get to know who you're talking to or who's speaking to you. I've been with Pristine more than 8 years, but as far as a trained trader and instructor, that's been 8 years. Before that, graduated, as Reed said, from Pace University, and knew what the markets have to offer, and just dove headfirst right in. Started trading the E-mini futures initially, and then gravitated over time towards Forex, for many reasons, which we'll talk about. And I do lead our Forex program, teaching our course and helping guide our traders as well. Standard disclaimer real quick, just to get it out of the way, guys. It is possible to lose money. I'm sure you all know that, and if you don't, you will soon find it out once you start to dig into this a little deeper. But I personally think that the bigger risk is in not getting really any education or the right education for you. Right? Everybody's going to hear things over the course of today, in this venue that Investor Inspiration and Reed have put together here. You've heard a bunch of different things, and it's really about just finding what connects with you and making sure that you at least do something, right, if you hear something that makes sense. Because again, without the right education or an education at all, it's basically the blind leading the blind. You wouldn't allow a pilot to fly you from Las Vegas to New York if he's never flown before, if he's never had any experience. So why should you trade any of your hard-earned capital without having any kind of knowledge? Right? So enough about that. Like I said, it is possible to lose money, so do your due diligence. Now, why should you trade Forex? And just real quick, so I can kind of get to know you guys, how many of you trade Forex? Give me a yes. And how many do not? If you do not, just type in an N or a no, just so I can kind of better gauge the group here. I'm seeing plenty of yeses. Awesome. I appreciate the response. Couple no's. All right. So for those of you who are saying no, as I said before, what we talk about here right now in this session can be applied to anything that you trade. So the concepts and ideas can certainly be translated to stocks, futures, whatever. But hopefully this will open your eyes to the potential or the opportunities that Forex does offer. And I'm not even trying to say to leave whatever you're currently trading and move to Forex exclusively, but even just as far as diversification, because sometimes, let's face it, markets are quiet. They're not doing anything. Forex offers a 24-hour opportunity to make money. So we'll talk about some of those advantages as well as some of the common misconceptions. So liquidity, it is second to none. I mean, nothing even comes close. You're talking about the most liquid market in the world. And just to put it in perspective, right, I think we all are fairly familiar with Forex doing $4 to $5 trillion in terms of daily transactions. But to kind of, as I said, put it in perspective, the U.S. stock market does $191 billion, which tremendous amount of money, of course, but pales in comparison. The futures market does $437 billion in terms of daily transactions. Okay? And then, of course, you've got Forex, which does, as I said, $4 to $5 trillion in daily transactions, which is just, as you can see, head and shoulders above these other markets. So there's no real worry about manipulation in a sense. I mean, yeah, there can be some games getting played, some of the banks, kind of throwing their weight around from time to time, but there is just so much liquidity that if you're following the trend, if you know what to be looking for, it's going to be difficult to, get get hurt in a major type of way. And you're right, it is far less regulated, which I think is to your advantage, meaning there's no day trader rule. You don't have to maintain a $25,000 account. There's no uptick rule. You can short at will. If something's falling, nothing says that you have to wait for an uptick before you can get short. You want to crush something even more, by all means, go right ahead. So I think that it being less regulated in some respects can work out for us because, let's face it, there have been a lot of handcuffs getting put on us or those equity traders in terms of trying to counter the backlash or the fallout from certain Ponzi schemes and just overall bad name day traders. So you've got liquid before
Hi, Kurt. We seem to have lost audio with you. If you're using a headset, we've had issues with that earlier today. Can you please call in using your telephone because it seems like that's not really the strongest audio.
Okay, yeah, no problem. What
Well,
number?
you're good. You're good right now. So if it happens again, we'll just have to go to the telephone. Okay.
Okay, yeah, and if you could just in the meantime private message me the number and code, this way I have it in case.
For sure.
Perfect. Awesome. All right, so should hear me now, Paul. Thing was, you've got a job. Maybe your schedule, for whatever the reasons may be, doesn't allow you to be in front of the computer at certain times. So again, it's extremely customizable. Things are constantly moving, whether it's the Euro US dollar when the London session opens or when the New York session opens, or when it's, say, Aussie yen later on in the evening. So very opportunistic and constant movement. So because one day to the next, which is another, I think, big advantage. A lot of Forex patterns or charts will follow through extremely well, and they'll adhere to the technicals because of that, right? Because the market is seamless. And as I already said, there's enough liquidity to get in or out at any time. Real quick, just a breakdown of the different market sessions, when they're open, when they close, when you've got the overlap. The overlap is the most volatile period of time. That's when you've got the most volatile period of time, and at times, sometimes the most opportunities present themselves. Other times, not so much. I find that between 3 and 4 in the morning, all the way until 12 o'clock, there's plenty of things to do. There are plenty of trades that are setting up. As you get into the later part of the afternoon, New York time, things start to slow down, especially if you had movement earlier. But then things will start to ramp up again as the Sydney and Tokyo sessions are going. So you'll start to get action again 7, 8 o'clock in the evening and on. In addition to those advantages, you've also got a lower cost when it comes to Forex. Typically, there's no commissions as it's built into the spread. And I'm not going to spend a ton of time here. If you want to talk more about this, we can do so offline, but just time-wise, I'm going to go through these a little more quickly so we can look at charts. But there's typically, as I said, no commission. Right? You also have no trading or platform fees, or data fees, or exchange fees. So there's a lot of this additional overhead that you might have to incur as an equity trader that you don't have to incur when trading Forex. So you can, use more of your capital to trading rather than expenses. And before we go any further, real quick, just before we start talking charts, for those of you who have not traded Forex before or maybe don't know a whole lot about it, we're looking to capture what's called a pip or pips. And it's simply the smallest incremental move up or down that a Forex pair can make. So you've got standard lots where 1 pip is equal to $10 for US dollar pairs, and you've got mini lots where 1 pip is equal to $1. Right? And there are micro lots that you can consider trading. I'm not going to cover it here, but you do have even smaller lots that can be traded as well. So this kind of keeps it simple, and just as an example, if you had a 5 pip move in your favor, if you had 1 standard lot, that'd be a $50 move, right? Or a $5 move if you had a mini lot. So again, a pip is nothing more than the smallest incremental move a Forex pair can make, and what we're trying to capture as Forex traders. Now, many out there, many other places will say that you need 1, 3, or all of these subjective tools in order to weather retracements, Elliott wave, trendline, MACD, etc. Do you really need these? Are these really things that are a necessity to being successful? And it's my opinion that they're not, but why are they not? The reason that, in my opinion, they are not needed is for one very simple reason, and I'm going to ask you guys to help me with answering it. What are all of these things based on? In other words, what do these all need in order to provide any type of real value? Right, history, price movement, exactly, that's exactly right. They need price, and as Jen is saying, they lag because they're needing price. They're reacting to what price is telling us. So if we can really understand price movement, then we can begin to move away from the crutches or the handcuffs that these subjective tools put on us. Because what ends up happening, right? What ends up happening is you end up looking at a chart that's something like this, where you've got the chart, you've got the candles, but you've also got all of these other tools that are slapped on the chart because you heard from this guy you need to have the MACD, you heard from this guy you need the RSI, and then you heard from somebody else you need the fib retracements, and before you know it, you're looking at a bunch of spaghetti on the chart, and you're hoping that they all come into alignment, that they can all give you a clear signal, but the reality is that oftentimes doesn't happen. You're oftentimes faced with a confusing situation where you need to decide which ones am I going to believe in and which ones am I going to kind of brush under the table for right now. And that's no way to really be confident about your trading. How can you ever really expect to be confident and successful in what you're doing if you're always kind of tiptoeing the tightrope, so to speak, and trying to balance it all out? So you need to focus on what really matters, and that is, in my opinion, price, multiple time frames, support and resistance, and even the use of 1 or 2 moving averages. That's it, right? So what you end up with is a chart that looks like this. This is what you're looking to achieve when it comes to, your charts and what you're looking at, what you're making your decisions on, because this is what everything else is based on. So as I look at this chart, and guys, can you just confirm that you can see my arrow, my mouse? Can you see that moving around right at the top of the chart there? Okay, perfect. Appreciate it, guys. Thank you much. All right. Well, you don't have to worry about volume, no. Not with Forex, at least. If you're trading stocks, then volume is something that you want to consider. But when it comes to Forex, it's not something you need to be worried about. Right? So as we look at this chart, now mind you, it's only price and 2 moving averages. We've got a failed breakout up here, followed by a very bearish wide range bar, penetrating deeply into support and eventually breaking the support, right? So this move down breaks under support to the left. Therefore, the next retracement right here becomes something of short interest for me. And as you can see, price continues to steadily move lower. Right? These are exponential moving averages. Right? It's the 8 and 21 exponential moving average. And, there's nothing, in my opinion, special about them. It just is what I feel works well. Right? Whatever moving averages you choose to use, whatever you feel works the best, just stick to those, whether it's simple, exponential, whatever. You just have to make sure you stay consistent. Don't start putting the 8 and 21 exponential plus the 40 period simple moving average and start getting things very cluttered, right? Simple, as they say, is best. Okay. So based on what I've been telling you, the best part of all this, right, is that what I'm going to show you works on any time frame. So it doesn't matter if it's the daily, it doesn't matter if it's with regard to Forex, the 4-hour, it doesn't matter if it's the 15. It works on any time frame and on anything you're looking to trade. So while the focus is more on Forex for this presentation, you could almost imagine the charts that we're going to look at as if they were equities, because the analysis would be the exact same. What is your preferred time frame for entry and confirmation? It depends on the time of day. During the higher volatility period, so London session, New York session, I will look more at the 15-minute charts with confirmation coming from the larger time frames such as the daily chart. And then as we get later on into the afternoon, 3, 4 o'clock and on, I'll switch over to hourly charts just so I can see a little less information. Things start to thin out a bit. So I'll go to the hourly chart and again still use the daily for that confirmation. All right, so let me just show you also how this works on whatever time frame you're looking at. So we're starting with a weekly chart, right? We're starting with a weekly chart, and here, this break lower is the first indication of a trend change as we're now breaking under this pivot low. So this now begins to shift your bias to being more bearish. Now, from the weekly point of view, you really don't get any signal on the way down. Unless you shorted the breakdown right here, there was really no signal in this move lower. That being said, you could have gone to the daily time frame or the 4-hour time frame and found an opportunity to get in here. Right? So you can take the bias from the weekly, which is now bearish, and go to the smaller looking for your entry. Price then consolidates sideways within this downtrend. You could have shorted this breakdown. You could have shorted this retracement. Price then does this little double bottom, moves up into resistance. You start to get these topping signals, right? Look at these bullish candles. Bullish candle here, which is a bottoming tail, no follow through. Bullish candle right here, no follow through. Right? This was a bullish candle at one point in this weekly bars formation. So in other words, at some point during this week, it was trying to break out above the top of the range, but the sellers came in and drove it down. Think about for a moment, and this is really what you need to do when looking at candles. Think about the emotion that traders would have been having, right? And put yourself in it, because look, I'm no different from you. We all experience the same emotions. Maybe we have different thresholds or pain tolerances, but we all experience the same emotion. Right? So if you can imagine for a moment this bar being a full-bodied green candle up at these highs, what would you be thinking? What would you be thinking if that were the picture that you were looking at? Would you be thinking price is moving higher or lower? And granted, this is just one part of the analysis. Right? Exactly. You'd be thinking that price is going to be moving higher based on this coming up to the top of the range here and looking as if it's going to break out. But as I said, that's just one part of the analysis. You have to look to the left and you see that you're into resistance and the overall trend is still down. So it really wouldn't be a high odds long entry. And as it turns out, would have been a beautiful place to get short, as this then resumed the downtrend and continued moving down. Yeah, exactly. It would look like an engulfing bar, at least at that moment in time. So that's the weekly chart. If we go to the daily chart, same thing, right? Here's the daily chart trending down. So the bias should be bearish. Price then begins to go sideways once again. You see all of these bullish candles, right? I can highlight them. Right? Bullish candle here, and here, right? And here, having very little, if any, follow through. So when you have bullish candles like this, having very little follow through, if any, within a downtrend, that tells you that sellers are still very aggressive, the bears are still in control, and that you want to be looking for price to move lower. Now, look, during the time where this went sideways, you could have shorted every move up into the top of this range. But then, as price begins to break down here, you want to start thinking, now we're going to resume the downtrend. This is where I can make some of the bigger money, right? You know, because the truth is, you can make money trading sideways ranges. Right? You can just pick the top and the bottom and do that all day. But the bigger money is going to be made in capturing those trends, which you can find and identify from the daily time frame. So if you shorted this breakdown here, this would have gone for over 400 pips. And so if you were trading one standard lot, that would have been the equivalent of over $4,000 in a short period of time. You're talking about a week and a half. And you know, let's say you're not trading a standard lot at that point. Let's say it's a mini lot. You're talking about $400. Might not seem like much to some, but to others, hey, if I could make $400 in a week and a half and very little work, that sounds like a pretty good deal to me. That sounds like a pretty good way to bring in a little extra income. But the truth is, it's not even really about the money, right? The money is why we do this, of course. I get that. But if you focus on the money, it's going to be very hard to make it. right? It's going to be very hard to make the money. You need to focus on the process. You need to focus on the things that I'm talking about as far as the analysis goes. Right. So let me get rid of those highlights. Here's a 4-hour chart. So again, I'm just going through, starting from the weekly and moving down to the smallest time frame that I will trade from, and showing you it doesn't matter. Right? Here's a wide range bar moving up. Price pulls back, and again, this is the 8 and 21 exponential moving average. Right? So price pulls back. You get what we refer to as a pristine buy setup, and you can see where the entry was, and boom, off it goes. At the time this chart was captured, you're looking at an 87 pip move, and this is off a 4-hour chart, so you're talking in 12 hours, right? You're up almost 100 pips. Do you trade end of day? I'll trade, I'll hold things overnight. So sometimes I'll be in and out within the same day. It really depends on the larger time frame, depends on the entry that I get and how the trade is behaving. Here's a 1-hour chart. And again, you can see the entry, price pulls back, another buy setup. Follow through meaning that you're getting follow through to the position. It's moving in the direction you expected it to. Now, certain times, depending on the trend, you should expect follow through. Other times you should not. So if I go back real quick here, as I said to you, these bullish candles having no follow through, in other words, what I'm saying is these bullish candles were not moving higher in the way that you would expect them to had it been in an uptrend. So the fact that bullish candles are not moving higher in any significant or substantial way means, right, it means that the bears are in control, right? Exactly, as Money saying, sell, sell, sell. Right, exactly. Right. So here's an hourly chart of Aussie yen, and again, it doesn't matter what pair you're trading, it doesn't matter what time frame you're trading from, right? It's just about the process. It's about finding the patterns that you're identifying within a trend. The 8 and 21. The 8 and 21 exponential. So here again, entry is moving up about 80 plus pips on a 20 pip stop. In other words, if you were risking $200, you're up 800, or if you were risking 20, you're up 80. Pretty good R to R there. Do you have guidelines relative to your stops on different time frames? Not really, no. I mean, depending on the pattern would dictate where my stop goes. Generally speaking, the stop is going to be, if long, below support. So if I'm going to get long, I'm going to look to put my stop below support, right? Because I don't want to see price come back down a little bit, tick me out, or whip me out into support and then turn back up and go in my favor. Right? As far as targets, it depends on the larger time frames. It depends on how much room there is to move higher. It depends on the resistance to the left. So, you might want to peel a little bit off at say the prior high because there's naturally going to be a little bit of a reaction there. But if you're trading in the direction of the trend and with the support, not meaning price support, but with the support of the larger time frame, you should be able to get a pretty nice run. Right? A lot of times what I like to do is use the 21 exponential as kind of a trailing stop to manage the trade. Right? As far as identifying support and resistance on the chart, all you have to do is look to the left. Right? All you have to do is look directly to your left until you hit price data. If there's something there, then you've got resistance, something meaning a cluster of opens and closes. And here's a 15-minute chart. Again, no different. Here, this is Aussie US dollar, and this is actually just from the other day. Breakout from a consolidation, pullback, buy setup. I mean, it doesn't matter what the time frame is. It does not matter what the time frame is. Now, both of these moves, the breakout and the pullback and subsequent move higher, went for about 30 pips, or a total of 60 pips, which would be the equivalent of $600 on a standard lot. Now, that's in a relatively short period of time. You know, if you could pull 30 pips from a move per trade and just do 60 pips a day or whatever the goal might be, you can make a living off of that, right? So you don't have to capture a tremendous amount of the move. You don't have to get everything. You don't have to buy the breakout and sit through the pullback. Right? You can just take your little pieces along the way and string those together and make a great living and lifestyle for you and your family. Again, the moving averages are the 8 and 21 exponential moving average. So I'm going to speed through a couple because I am running a little short on time, and I've got several examples that I do want to show you. So here, at this point, you know, we're going to bounce around a little bit in terms of the time frames. I've shown you how it works regardless of the time frame. So here you've got a 4-hour chart. You're welcome, Paul. And this is Euro Yen, not that it really matters, but 4-hour chart, breakdown, right? Trend is down, you short the breakdown. Whoops. So the trend is down, you're going to look to short the breakdown, and this one in about 8 hours time is up over 100 pips. Right? You can see how much money that would be the equivalent of, but like I said, I'm not even going to focus on that because the money will come if you follow the process. And that's just the honest truth. You know, I'm not going to try and sit here and, you know, just show you jaw-dropping amounts of money being made because, look, I mean, everybody knows you can make money trading. That should not be a shock or surprise to anyone. It's about the process you go through that matters. So here again, you're just trading in the direction of the trend. 90+% of the time, I'm trading in the direction of the trend. But look, I'm human. Not all of them are going to work out. It's what you do. It's how objective you can be when things don't work out. How ready will you be? And how are you going to react? That's what matters. Because sometimes you'll get stopped out, and it is significant in terms of meaningful, right, as far as the trend changing direction. Other times, you may have just been a little early to the party, right? As is the case with this example. This first buy setup failed, but it wasn't the end of the trend. As you can see, this second buy setup formed deeper into support to your left and worked its way higher. So again, just because you get stopped out doesn't mean you were wrong. It doesn't mean you had it, completely pegged the wrong way. It may just mean you were a little early. But other times, you may have been wrong in the analysis. Right? In our Forex course, we will teach you how to know the difference. But the bottom line is you need to know how to be prepared. You need to be objective. And look, I'm telling you right now, an RSI, a MACD, a fib retracement, none of those things are going to prepare you for what I'm talking about right now. None of those things are going to tell you if you are a little too early or what you're doing, you know. Yeah, you should be seeing my screen, Jim. I've got a slide up with a chart, Pristine Trading at the top, but you should see it. And thank you, Connor. I appreciate that. Here's another example, Euro US dollar. This was a sharp pullback, but into support. Now see, as I said before, somebody was asking, how do you identify support? Simply look to the left, right? And let me get my little highlighter here, right? I look to the left, you see this area of overlap? That's support. I don't have to look all this. This is not anything that I need to be concerned about. Doesn't matter to me. This, what's directly to my left, is what I'm focused on. So here's your pullback, starts to move up. I actually did not get in down here, right? I played this, I remember this one. I got in here and played it up to here, right? Due to the volatility, I'm not looking to be greedy. I'm just looking to get my piece of the move. So this was about a 90 pip move on a 45 pip stop. So basically 2 to 1. And again, like I said, guys, it doesn't matter the time frame. It doesn't matter anything. If you get the pattern and it's a favorable time of day given the pair you're trading, then by all means, go for it. Now, 10 misconceptions. I'm starting to run out of time here, so I'm going to go through this rather quickly. I'm not going to spend as much time as I would have otherwise. But look, Forex trading, any trading, it's not a get-rich-quick scheme. Right? You got to put in the work. If you want to make the money that you see people out there throwing around, look, you got to put in the work. You got to put in the effort. Right? It's possible, but you got to put in the effort. Forex is just for short-term traders? No, in fact, I would argue the opposite, right? The lowest time frame I go down to is the 15-minute chart. I'll trade the 15, I'll trade the hourly, even the 4-hour and the daily, as you saw. Yes, correct, Vince. 8 and 21 exponential. The market is rigged. Well, you know what? Not for nothing. You can say that about any market, not just Forex. You could say that about anything. So whatever, I mean, it's just something you got to deal with. And look, if you're trading in the direction of the trend, you're going to be far less susceptible to those whips. And if you know how to objectively read the charts, it's going to be a lot easier, and you're going to feel a lot less victimized, if you will. You can't be right every time. I mean, anybody that tells you they're right every time is, quite frankly, lying, in my opinion. You can't be. Not possible. You can definitely have a high batting average, but to be right every time, it's easy to make money trading the news. Not in my opinion. Maybe some people can do it, but I respectfully think that can only last for so long before you get bit. So I would not try and make a living trading the news. Right? The reaction to the news, okay, fine. Doing it in an objective way makes sense. The more trades and more pairs you're looking at, the better. Well, you know what? Honestly, I think you could get away just fine looking at 6 or 7 of the major pairs, the US dollar pairs. I personally look at 24 pairs. I don't trade all of them all the time. Sometimes I don't trade some of them for, days and weeks. The more complex the strategy, the better. Again, as you can see based on what I've been talking about, I don't think so. Right? And you can see these others. So again, I'm going to speed up here just a bit. Another trade here, US dollar, Canadian dollar, just doing the same thing. Right? Pound JPY, doesn't matter the pair, just matters that you're following the process. Buy the breakout or buy it here as it's moving higher. Beautiful run up to this prior pivot high. Euro US dollar, this is a 15-minute chart. This is a trade that I'm in right now as I'm talking to you guys. I captured it right before I came on. So 15-minute chart, moves higher above this range, moving higher very well. Right? US dollar, Canadian dollar, you can kind of just see the progression of this trade. And again, guys, I apologize for speeding up here, but the other presenter went a little long. I'm not trying to get everybody else behind as well here. I'll be doing a webinar similar to this in the near future. You can always go to pristine.com and see our free webinars that we have coming up. So, you can always check us out there or email me. I'd be happy to get back to you. You can email me, Kurt@pristine.com. So again, here's another one. Move up, $106. And that's on a mini lot. right? That's on a mini lot. So imagine, and I just wanted to do that, right? I put that in there so you could see that, look, even if you're trading a mini lot, the potential to make good money is there per trade. But even still, you got to crawl before you walk. You got to walk before you run. So again, going back to the whole idea that it's a process that you have to go through. Right? So Forex done the pristine way, multiple time frames, trends, support and resistance, understanding and use of subjective tools, but in an objective way, right? Reading price patterns and intermarket analysis, right? This is kind of the big picture of how to trade Forex in a professional and pristine manner. Right? And finally, guys, just special offer for you guys, exclusive offer, 7 Steps to a Good Trade ebook that we have. All you have to do is email counselor@pristine.com. No strings attached. We're not asking for a credit card. You don't have to, send us an email to not renew anything. I mean, this is just 7 Steps to a Good Trade ebook purely for you. Hopefully you find some value out of it and also out of this presentation that I have put together for you here. But, again, hopefully you take advantage of this. Just simply email counselor@pristine.com and we'll get that out to you. Otherwise, like I said, you can always email me if you have questions, or check out the website, pristine.com. We've got free webinars, every week, and like I said, we're always accessible. So I do appreciate your time, guys. Hopefully I didn't run too far over, but again, thank you. And if there were any questions I didn't get a chance to answer, just email me because I know somebody else has to come on. So I'd be happy to answer them there as well. All right. Yeah, you want the email? Sure. Kurt at pristine.com. All right, there you go. Hopefully it came through. I just put it into the chat. So there's the email. And like I said, you can email me for any questions, or if you want the ebook, email counselor@pristine.com. You can put in that subject, exclusive offer, and we'll get it out to you, okay? So again, thanks for your ears. Appreciate it, and thanks again to Investor Inspiration and Reed as well.